You don't actually own your retirement account. If it's pre-tax like a 401k or IRA, the IRS is your silent partner and they're just waiting for you to cash out so they can take their cut. And here's the thing, the longer you wait to do something about it, the more they take. Every year you delay planning, your flexibility shrinks, your RMDs grow, and your tax bill gets even heavier. But it doesn't have to be that way. In this video, I'll walk you through 3 real paths retirees often take, and I'll show you exactly what happened when we helped Jerry and Elaine choose the smartest one for their future. And yes, I know, you've probably heard about Roth conversions before, but what you're about to see is different. It's based on real planning, real trade-offs, and once you see what worked for them, you'll understand why this is the route most of our clients end up choosing. I want you to think about your pre-tax retirement money differently, not as a savings account, but as a debt account. If you've got a 2 million IRA, you don't really have 2 million. It's more like 1 million or 1.5 million after taxes, because the IRS takes a slice of every dollar that you withdraw for the rest of your life. And while most people assume their accountant is handling this, the truth is tax strategy like this usually slips through the cracks unless you take a big picture approach. Now, most retirees handle this in one of 3 ways. They delay taxes as long as possible, they go all in on Roth conversions right away, or they take a more strategic route. And we modeled all 3 of these paths for Jerry and Elaine. And not only did one of them work, it saved them around $400,000 in taxes and actually increased their lifetime after-tax income. Clients who see this strategy almost always say the same thing: why didn't I do this sooner? So let me show you why. Let's start with what most people do, which is nothing. Perhaps you delay Social Security, you take withdrawals as needed, and you hope the tax bill sorts itself out. Now here's what the situation looked like for Jerry and Elaine. Okay, so if we look at Jerry and Elaine's situation, right now they're both working and they're gonna work through the rest of this year. Together they bring in about $300,000 of income, and then they are both maximizing contributions to their 401ks, which are pre-tax. From an assets perspective, they have about $3.5 million in retirement accounts. You can see the breakdown here. Both of those accounts are 100% pre-tax. They also have some cash at the bank. The reality is we're not going to be touching this cash because they'd like to keep a nice healthy buffer in case for emergencies. They also own their home outright. For expenses, what they told us was they'd really like to spend no less than $10,000 per month after tax. And then they also would like to continue to do giving. So they do giving every single month right now when they're working, about $2,000 a month to the Human Fund.
There's a memo here from accounting telling me there's no such thing as the Human Fund.
Well, there could be.
But there isn't.
And then when they retire, they'll still do giving, but it'll likely drop down a little bit. So we've accounted for that. One other thing I should mention is that you will see right here that, again, we're waiting until age 70 to start their Social Security benefits. So you'll see these benefits are inflated a little bit. But as of today, Jerry's benefits are projected to be $3,600 a month at age 70. And for Elaine, it would be about $3,800 a month when she turns 70. And so what this does is it creates really a 5-year window where all their income needs to come from their portfolio before Social Security starts. And based on what we modeled for them, considering their income sources, considering how their portfolio was invested, considering their risk preferences, we could see that we projected they could withdraw about $15,100 a month gross from the portfolio. But of course, like I mentioned earlier, they don't get to keep all that income. So of that $15,100, after we account for both federal and state taxes, we can see that their net monthly income would be about $12,200. And the good news is that is enough to meet their goals. So it works, but there is a big problem. And what we can see here is that over their lifetime, they're projected to pay over $1.9 million in lifetime taxes. And this isn't because they were overspending, they just didn't have a strategy for when and how to pay those taxes. And again, once those RMDs kick in at age 75, this is only going to get worse. So again, they could live with this plan, but emotionally paying nearly $2 million in taxes just didn't sit well from them. And that's what moved them from doing nothing to looking at better options. Next, what we did is we modeled what would happen if Jerry and Elaine did the opposite.
Was that the opposite of what you were going to say, or was that just your natural instinct?
Instinct.
Stick with the opposite.
They converted everything in their IRAs to Roth all at once. And this strategy is tempting because on paper it looks clean. You pay all your taxes up front and then you never have to worry about them again. And what we can see here is that by converting all their money to Roth in 1 year in 2026 when they retire, right, we'll see that their total lifetime tax bill drops to about 1.4, almost $1.5 million. And what we can see is that it does bring down their total lifetime tax bill by about $504,000. And not only that, it's also eliminating potential IRMA surcharges in the future. So again, this might sound like a no-brainer until you look at what it takes to actually get here. So if we take a look at what the conversion would look like in that year and like how much would it cost them, we can see that they are projected to pay roughly $1.4 million in taxes in that single year to convert all that money to Roth. Most people don't even want to pay a $14,000 tax bill, let alone $1.4 million. So not only was this emotionally uncomfortable, but it also eliminates their ability to take advantage of lower tax brackets in the future. It is a huge bet you're making in 1 year against the future of tax policy, markets, and your own needs. And for Jerry and Elaine, it just wasn't worth it. So that's when we explored the third option, a more strategic and balanced approach. One that lowered their lifetime taxes, gave them more income, and also kept them below IRMA thresholds, and it didn't require writing a check to the IRS the size of a Manhattan brownstone. So here's how it works. After seeing both extremes, we landed on the solution that gave Jerry and Elaine the best of both worlds, a series of strategic Roth conversions done just under the IRMA thresholds. And if you don't know what IRMA thresholds are, just know they are an additional tax of sorts which increase your premiums for Medicare coverage. It's a sneaky tax many people aren't aware of until it's too late, but we strategically planned with this tax in mind. So by converting to Roth slowly but intentionally, we're going to fill up to and below that first IRMA bracket. We can see we dropped their lifetime tax bill to about 1.5 to around $1.6 million. And so what we'll see is that's a tax savings of about $405,000. But what makes it even more powerful is that you'll see their lifetime after-tax income also increases by about $405,000. That's real money they get to use and not hand over to the IRS. But now let's see how this works in practice. Okay, so if we see what the amount is that they'll be converting each year to keep them under that first IRMA bracket, so the first year would be in 2026. And what we can see is that the amount that they would be converting is around $32,000. So this is much more manageable. And the Roth conversion amount is this dark purple color here. So you'll see that for 26 all the way through 2030, we're going to be converting a very similar amount to the Roth. And then once we go into the first full year of Social Security, when they turn 70, which would be 2032, what we're going to see is that the Roth conversion amount actually does increase. And this is because more income is coming from Social Security. It doesn't need to come from the IRA. So we have a bigger bucket to work with to fill up via Roth conversions. And so that plan would continue until about 2035. Now, the beautiful thing about this strategy is it's manageable and it's sustainable. And most importantly, it's something Jerry and Elaine felt good about. It's something that they can stick to. They didn't have to bet everything in 1 year, and they didn't feel like they were being overly aggressive or overly passive. It just worked. And that's the key. On paper, maximum Roth conversions may save them a little bit more tax and create a little bit more after-tax income. But if it's not something you can stomach, then the most optimal strategy is worthless. Now, if you're wondering about RMDs, yes, they still have a meaningful IRA balance, but we set this up so that by the time RMDs begin, those withdrawals will be similar to what we're already taking. And that's exactly what you're going to see here. When you look at the light purple there, which are IRA distributions, when we go into 2036, what we're going to see is that's the first year that they start required minimum distributions. You'll notice that this, just to keep it simple, the size of that light purple bar and the size of the pink bar is very similar. And so we've strategically set this up so that it's a smooth transition and it's not a tax spike or a tax bomb when those RMDs do begin. And then eventually there will reach a point when RMDs exceed what they need later in life, and that excess gets funneled into their taxable brokerage account, still invested, still working for them. Now you might be asking, why not just convert more if there's excess RMDs later on? And that's the delicate balance. If you convert too little and you miss out on the opportunity. If you convert too much and the tax bill becomes overwhelming, especially if you're delaying Social Security and already drawing from the portfolio, then it becomes a problem. And this strategy right here is the one most of my clients land on. And every time they see the numbers, the lower taxes, the higher income, and the smoother ride, they say the same thing, which is, why didn't I do this sooner? So here's what I want you to take away from this. It's not just about minimizing taxes. It's about reclaiming control over your retirement. Jerry and Elaine didn't pick the path with the biggest tax savings. They picked the one that gave them confidence, the one that increased their income, the one that avoided Medicare surcharges and still gave them room to give generously and travel while they're still healthy. The strategy they chose wasn't extreme, and it wasn't necessarily complicated. It was simply aligned with their goals, their comfort, and their long-term plan. And they didn't need to chase perfection, they just needed a plan that worked. And that is what most people want. Not a generic strategy, but a path that fits your life, your portfolio, and your values. So if you've saved the majority of your money in pre-tax accounts and you're wondering if there's a smarter way forward, this kind of planning might be the clarity you've been looking for and something we and my team can help you with. Our contact information is in the description below of this video. Now, if you want to see what retirement can actually look like once you get the tax strategy right, and especially if you're wondering what changes as your net worth grows, my business partner Anthony made a video you won't want to miss, which is what life actually looks like retiring with $6 million. He walks through the freedoms, the surprises, and even the tough decisions that come with this level of wealth. You can watch that right here. And even if you're not quite at that number, the core principles in that video will change how you think about your own retirement. I'm Alex Okagawa, certified financial planner and partner here at 1 Degree Advisors. Thanks for watching, and we'll see you in the next video.